Governments borrow money every year. This is not unusual. It is not even controversial. What is unusual is the scale. Across much of the developed world, national debt has grown faster than populations, faster than productivity, and often faster than economic output itself. Yet markets continue lending. Investors continue buying government bonds. Central banks continue supporting financial stability. This creates a strange situation. The system depends on debt, but also depends on confidence that the debt remains manageable. If governments reduce borrowing too aggressively, economies may slow. If they continue borrowing indefinitely, debt burdens continue expanding. This is the story of sovereign debt and how modern governments became trapped between growth, stability, and obligations that never truly disappear. Government debt, often called sovereign debt, is money borrowed by national governments to finance spending beyond current tax revenue. When governments spend more than they collect, they issue bonds. Investors purchase these bonds and receive interest payments over time. In theory, debt allows governments to smooth economic cycles. During recessions, borrowing can support employment and demand. During emergencies, debt can finance responses without immediate tax increases. Historically, sovereign debt was often associated with wars, infrastructure projects, or temporary economic disruptions. Over time, however, debt became a permanent feature of modern economies. Governments increasingly relied on borrowing not only during crises, but during normal periods as well. At the same time, financial markets expanded dramatically. Pension funds, insurance companies, banks, and central banks all became major buyers of government bonds. This created a feedback loop. Governments needed financing, markets needed safe assets. Government bonds fulfilled both roles. As a result, sovereign debt evolved from an occasional policy tool into one of the foundations of modern finance. Government debt promised flexibility. Instead of raising taxes immediately or cutting spending during difficult periods, governments could borrow and spread costs across time. This approach supported economic stability. Borrowing allowed countries to finance infrastructure, social programs, defense spending, and crisis responses without requiring immediate sacrifices from voters. The promise extended beyond politics. Government bonds became the benchmark asset of global finance. Banks used them as collateral. Institutional investors relied on them for predictable income. Central banks treated them as key instruments of monetary policy. The broader assumption was that sovereign borrowers would remain reliable indefinitely. Countries with strong economies could always refinance existing debt by issuing new debt. As long as investors maintained confidence, the system functioned smoothly. The promise was therefore not repayment in the traditional sense. It was rollover. Debt would mature, new debt would replace it, and economic growth would gradually keep the burden manageable. This assumption became deeply embedded in modern financial systems. The rise of government debt accelerated over the last several decades. Globalization increased public spending demands while aging populations expanded pension and healthcare obligations. Financial crises added further pressure. Following the global financial crisis of 2008, many governments increased borrowing dramatically to stabilize economies and support financial institutions. Years later, the pandemic triggered another wave of debt issuance on an unprecedented scale. At the same time, interest rates remained historically low. Borrowing appeared inexpensive. Investors searching for safety continued purchasing government bonds despite low yields. Central banks reinforced this trend through asset purchase programs, accumulating large quantities of sovereign debt. The result was a financial environment where debt growth appeared sustainable. As long as interest rates remained low and investors remained confident, governments could refinance obligations without significant difficulty. Debt became normalized. What was once considered extraordinary gradually became routine. The rise of sovereign debt did not occur because governments expected collapse. It occurred because borrowing consistently appeared easier than alternatives. The system rewarded expansion. And for many years it worked. Government debt systems rarely fail through sudden default. They fail through pressure. The challenge emerges when debt grows faster than the economy's ability to support it. As obligations expand, governments become increasingly sensitive to interest rates. Even modest increases in borrowing costs can significantly raise debt servicing expenses. This creates a difficult trade-off. Reducing debt often requires spending cuts, tax increases, or slower economic growth. Continuing to borrow increases long-term obligations. Neither option is politically attractive. The system therefore tends toward delay. Debt is refinanced rather than reduced. New obligations replace old ones. This process works as long as investors remain confident. The problem is that confidence itself depends on future expectations. Investors buy government bonds because they believe future governments will remain capable of meeting obligations. If that belief weakens, borrowing costs can rise rapidly. Higher rates increase interest expenses. Higher expenses increase borrowing needs. Borrowing needs increase investor concern. The cycle can reinforce itself. Governments with reserve currencies often possess greater flexibility because global demand supports their debt markets. However, even these systems remain dependent on confidence. Central banks can provide support by purchasing government bonds or maintaining liquidity. But excessive reliance on monetary support introduces new concerns regarding inflation and policy credibility. The vulnerability is therefore not debt alone. It is dependence. The more a system relies on continuous refinancing, the more sensitive it becomes to changes in confidence and funding conditions. Modern sovereign debt systems function because markets believe they will continue functioning. That belief is powerful, but it is not guaranteed. A sovereign debt crisis rarely begins with a missed payment. It often begins with rising borrowing costs. Investors demand higher yields to compensate for perceived risk. Governments face increasing refinancing expenses. Budgets become strained. Economic growth slows. Confidence weakens further. If markets lose trust completely, financing conditions can deteriorate rapidly. Governments may be forced to implement austerity measures, seek external support, or rely heavily on central bank intervention. The collapse is not always dramatic. In some cases, it emerges gradually through years of stagnation, reduced investment, and declining fiscal flexibility. The common feature is loss of optionality. Governments become constrained by obligations accumulated over decades. After sovereign debt crises, countries often pursue reforms designed to restore confidence. Spending priorities change. Fiscal rules are strengthened. Debt structures are adjusted. Investors gradually return once stability improves. Yet debt itself rarely disappears. It is restructured, refinanced, or absorbed into new frameworks. The cycle continues because modern economies remain dependent on borrowing. Debt remains both a solution and a vulnerability. Government debt is often described as a burden. In reality, it is also infrastructure. Modern financial systems rely on sovereign debt as collateral, as investment assets, and as policy tools. The problem is not borrowing itself. The problem emerges when borrowing becomes the primary mechanism for solving every challenge. Debt creates flexibility today by creating obligations tomorrow. As long as growth, confidence, and liquidity remain intact, the system appears stable, but stability depends on conditions that cannot be guaranteed indefinitely. The sovereign debt story is therefore not about default. It is about dependence. And dependence becomes visible only when options begin to disappear.